David, we're in very complex and uncharted territory with what's happening in the UK. It wouldn't amaze me if we had situations like that in more places.
The world's financial markets are going through their most painful change since the global financial crisis.
Now, the British pound has fallen to its lowest level ever against the US dollar.
Global stock markets have sold off sharply, and bond portfolios have lost an astonishing 21% this year.
Well, we got a milestone in the currency markets today that we want to talk about. The euro hitting parity with the US dollar for the first time in 20 years.
Well, we have an extremely unusual situation on our hands.
And we saw a flight to safety to the US dollar, which is hurting currencies around the world. The rupee weakening today, hitting a new all-time low again as it plunged in trade.
Falling stocks and bond prices have wiped off $36 trillion of global wealth this year so far.
One big reason that stocks have been volatile is because the bond market has been, well, a disaster. Rates up 50% in a matter of weeks. Bonds selling off all over the world. In fact, your next guest warns this might be the worst bond market of our lifetime, and it will matter to stocks.
Americans alone have lost $9 trillion of wealth. This is only the beginning.
The world's richest people who have registered a sharp decline in their wealth in the first half of 2022. According to a recent study, these world's 500 richest people have seen their wealth go down by $1.4 trillion in the first 6 months of the current year.
There will be a lot of pain in future. The most puzzling thing is that all of this is happening because American economy is too strong. Let's see why and also what you can do to protect yourself. To solve this puzzle, we need to start with the US dollar. The US dollar is up 18% this year to date against 6 major currencies around the world. This happened because the Federal Reserve of America is trying to reduce inflation from 8.3% to its target of 2% by raising interest rates on borrowings. It already increased interest rates from near zero in March of this year to 3.25%, its steepest increase in 4 decades. It's likely to increase it by another 1.25% this year. The plan is that when it's expensive to borrow money, Americans will borrow less and spend less, reducing inflation. Americans here include individuals and companies. Inflation will reduce when you indirectly reduce spending by making borrowings more expensive, but this will happen over a few months or years. But the stock, bond, and currency markets react immediately to increase in interest rates. They don't sit around and wait. There is an enormous pool of money that goes wherever it gets highest rate of returns with the lowest risk around the world. Since they get higher returns in America, the US dollar investors began selling assets in other currencies and started buying assets in US dollars. And to stop their currencies from falling too much, central banks in other countries around the world are forced to increase their interest rates too. Countries like China and India import most of their energy supplies. Crude oil is quoted in US dollars. So when US dollar value increases, their imports become more expensive. So besides increasing its interest rates, China is also making it harder to sell their currency, yuan. Central banks of India, Thailand, and Singapore are selling their foreign currency reserves to directly buy their currency in order to stop them from falling too much. Excluding China, emerging market currency reserves have fallen by over $200 billion in the past year, according to JP Morgan Chase, the fastest fall in 2 decades. Normally, only the developing economies like India and China struggle when the dollar increases and their currencies fall. But this time, even the developed countries like Europe, Japan, South Korea, Sweden, and Britain are struggling. They are struggling to attract the floating pool of capital I talked about by raising interest rates. This is because of the Ukraine war. Russia has cut off its gas supplies to Europe, and because of that, Europe is about to plunge into a recession starting this winter. South Korea and Japan are suffering the knock-on effects of an economic slowdown in China, brought about by its housing crisis and zero COVID policy. I made a video about the slowdown in China. Check it out. So let's quickly recap. To fight inflation, the Federal Reserve of America is increasing interest rates. This is causing the US dollar to increase against all the other currencies, forcing them also to increase their interest rates, even though it's hurting their economies. So inflation in America is causing a chain reaction that is destroying almost all the economies in the world. So like I just explained, the cause of all the world's economic problems is high inflation in America. The inflation is not only hurting the entire world economy, it is also hurting Americans. American stocks have fallen for 3 consecutive quarters and sharply recently. Gas prices are very high, even though they came down a bit. Despite this panic in the financial markets and despite the immense pain increasing interest rates in America are causing around the world, this is what the Federal Reserve Chairman said recently.
We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability.
Why is the Fed determined to continue increasing the interest rates even though it's causing so much pain around the world? To answer this question, we need to understand why the American economy is so strong in recent years. Let's understand this strength by looking at the American real estate market, corporate America, and the US consumer behavior separately. 1 year ago, 30-year fixed rate mortgage was less than 3%. Now it is almost 7%, the highest in more than a decade. A steep increase in mortgage rate usually kills construction activity almost totally. But that is not happening this time because of a huge shortfall of homes. This is both a long-term and a short-term trend. I made a video about this explaining the shortage. You can find this somewhere here. The inventory of homes available for sale remains very low by historical standards. In the years before the pandemic, house building in the rich world, once adjusted for population, had fallen to half its level of the mid-1960s. Increase in demand is supposed to increase construction activity, but because of many constraints, that had not happened, which resulted in increased prices. In the short term, COVID has reduced the supply of new homes both because of lockdowns and material and labor shortages. Builders are grappling with high costs and delays for raw materials such as cement, copper, lumber, and steel. There is a huge shortage of construction workers, such as carpenters, plumbers, and other workers. So once the lockdowns have been lifted, the builders are still building despite mortgage rate increases because of the huge backlog of unfinished homes to deliver. Corporate America's post-tax profits reached 12% of GDP in the second quarter, the highest since at least the 1940s. They took advantage of robust demand post-pandemic to pass on inflated input costs to customers, protecting their margins and then some. So American companies are making more profits than ever before and are sitting on a cash pile of $2.8 trillion. Companies are hiring and not firing because it is profitable to do so. Companies are also hiring because of the kind of things Americans are buying. During the pandemic, goods consumption shot up as people bought new couches, bigger television, and fancier exercise bikes for their homes. Post-pandemic, Americans are returning to cruises and concerts, industries that are labor-intensive. Even if consumers spend less on aggregate, they are spending more on the kind of things that require lots of workers, boosting employment. This explains why in the labor market there are 2 jobs available for every unemployed person. Also why wages are up 7% compared with the year earlier and are rising at their fastest pace since the early 1980s, according to the Atlanta Fed. The American government was more aggressive than others in stimulating the economy during the COVID-19 pandemic. This is when the government mailed out stimulus checks to everyone. Though stimulus formally ended some time ago, hefty dollops of stimulus cash are only just hitting the economy. States were granted about $200 billion in direct emergency funding as part of the stimulus, and they could spend only a fifth of it so far. Even more importantly, households like you and me are sitting on about $2 trillion in excess savings relative to the average before pandemic. These reserves have enabled them to spend at a high rate even as inflation has eroded their incomes. So now you understand why the American economy is so strong and the level of economic activity is so high. It is basically because of 2 reasons. 1, the federal government generously mailed out checks to everyone, and 2, housing shortages. All this economic activity has resulted in an inflation of 8.3%, much higher than the Federal Reserve's target of 2%. The central bank, as we heard from its chairman, is committed to bringing it down by aggressively raising interest rates. This is forcing other central banks also to raise interest rates, as we saw earlier. And now here's the risk. Because the global economy is connected, there is a terrible risk that the central banks might overdo it and cause a global recession. When central banks raise interest rates, they're discouraging spending, but its effect is felt across borders too. So when the American central bank discourages spending in America, that reduces the amount Americans spend on imports from, say, Britain too, slowing their economy. If such spillovers are not considered, the global economy will slow down by more than central banks had individually aimed to achieve. As the interest rates across the world spiral upward in an uncoordinated manner, the probability that an economy emerges from this experience unscathed sinks even lower. Research published by Bank of America finds that from 1980 to 2020, when inflation rose above 5% in rich economies, it took an average of 10 years to fall back to 2%. So this fight with inflation will be a very long one, and when it is on, there will be a lot of economic pain. So the best thing you can do to both help yourself and to help reduce inflation is to spend less. You might be tempted to spend your savings, but try not to. If you like such macroeconomic videos, I recommend you watch this video on the Indian economy, where I analyze its strengths and explain why it is likely to be the world's largest economy once again. I'm Sharat Mantravadi. Thanks for watching.